Most people's relationship with leverage is shaped by how they first encountered debt. Consumer debt, credit cards, car loans, financing things that depreciate or produce no return. And from that experience, debt becomes associated with risk, with overextension, with financial instability, which makes leverage in real estate feel like a dangerous version of the same thing. It isn't. Not because debt in real estate is risk-free, but because the structure is fundamentally different, and the risk profile that comes with it is fundamentally different. Leverage in real estate is a specific structural mechanism. A relatively small capital input, the down payment, controls a significantly larger asset. The return, appreciation, debt paydown, cash flow, happens on the full asset value, not just on the capital deployed, which means the return on the capital deployed is amplified relative to what a cash purchase would produce. That amplification is leverage, not borrowing to speculate, not financing a depreciating asset. A structural arrangement where a smaller capital input controls a larger productive asset and earns returns on the full value of that asset. The distinction matters because the return math is completely different. A cash purchase of a property earns returns only on the capital deployed. If a property appreciates 10% and you paid cash, you earned 10% on your capital. If the same property appreciates 10% and you put 20% down, you earned 50% on your capital, because the 10% appreciation happened on the full value of the asset, while only 20% of that value was your capital. The leverage amplified the return on capital by a factor of 5, not through speculation, through the structural mechanics of how the financing interacts with the asset's performance. This amplification works in reverse, too. If the property declines 10%, the leveraged investor loses 50% of their capital. The cash investor loses 10%, which is where the risk conversation usually ends. And it's true, leverage amplifies losses as well as gains. But the conversation that stops there misses the more important question. Under what conditions does a leveraged real estate position actually produce a loss on capital? Not a decline in property value, which is a paper loss on an asset that is still producing income, but an actual loss of capital. An actual loss of capital in leveraged real estate requires a specific combination of events. The property loses value significantly, and the cash flow is insufficient to service the debt, and the investor is forced to sell into the depressed market. All three simultaneously. Remove any one of those conditions, and the leveraged position can survive a significant decline in property value without a permanent loss of capital. A property that has declined in value but still cash flows adequately to service the debt doesn't require a sale. The investor holds the position. The debt continues to be serviced. The property continues to produce income. And when the market recovers, as real estate markets in structurally sound locations have historically done, the paper loss reverses. The risk of leverage isn't uniform. It's specific. It's manageable. And understanding its actual structure is what changes how it gets evaluated. The risk of leverage in real estate is not what most people imagine it to be. Most people imagine leverage risk as prices fall, you lose money. The more leverage you used, the more you lose. That's a partial picture, and a partial picture produces incomplete decisions. The actual risk structure of leverage in real estate is more specific and more manageable than the general fear of it suggests. The primary risk of leverage is cash flow failure, not price decline, cash flow failure. The leveraged position works as long as the income from the asset is sufficient to service the debt. The tenant pays rent. The rent covers the mortgage, taxes, insurance, maintenance. Something is left over as net income. As long as that structure holds, a decline in property value is a paper loss on an asset that is still working, still generating income, still paying down the debt, still building equity through debt reduction even as the market price has moved lower. The leverage isn't dangerous in that scenario. It's just carrying a position through a period of market weakness. The leverage becomes dangerous when the cash flow fails, when vacancies are extended and the mortgage still comes due, when rental rates in the market fall below the cost of servicing the debt, when carrying costs exceed income for long enough to exhaust reserves. These are the conditions under which leverage becomes a genuine risk, not price decline alone. Cash flow failure combined with an inability to service the debt from reserves or other income. Which means the risk management for a leveraged real estate position is primarily about cash flow and reserves, not primarily about predicting market direction. A position underwritten conservatively, with realistic vacancy assumptions, adequate reserves, and a debt service coverage ratio that provides meaningful cushion, carries a very different risk profile than a position underwritten aggressively with optimistic assumptions and minimal reserves. The second dimension of leverage risk is forced sale risk. A leveraged position that has declined in value only produces a permanent loss if the investor is forced to sell into the depressed market. Forced sales happen for specific reasons: cash flow failure that exhausts reserves, personal financial crisis that requires liquidity, loan terms that force refinancing in an unfavorable environment. A leveraged position that can be held, that cash flows adequately, that has the reserves to absorb disruption, doesn't have to be sold into weakness. It can be held through the cycle, and real estate markets in structurally sound locations have historically recovered from cyclical declines. The investor who understood the actual risk structure going in, who sized the position correctly, underwrote conservatively, maintained adequate reserves, holds through the weakness, and the paper loss becomes a temporary mark-to-market event rather than a permanent loss of capital. This is why the question isn't whether to use leverage, but whether the specific leveraged position is structured to survive the conditions under which leverage fails. Cash flow adequate to service the debt under realistic occupancy assumptions? Reserves sufficient to absorb an extended vacancy or an unexpected capital expenditure? Debt terms that don't force a refinancing at an unfavorable time? A leveraged position that answers yes to all three is a position where the risk is understood, structured, manageable. Not eliminated, managed. And managed risk produces different outcomes than avoided risk does, especially in an asset class where the return amplification of leverage compounds significantly over time. Before this continues, if you felt seen instead of sold to, that's the entire point of Relentless Wealth. Like the video, subscribe. We're just getting started. Paying cash for real estate is commonly understood as the conservative move. No debt, no mortgage payment to worry about, no leverage risk, full ownership from day one. And there is something genuinely conservative about it. The financing risk is eliminated. The cash flow doesn't need to service debt. A market decline doesn't threaten the position through forced refinancing or debt service failure. But conservative doesn't mean lower risk overall. It means the risk has been shifted, not eliminated. A cash purchase creates concentration risk. When a significant amount of capital is deployed into a single asset, all of it, without the amplification of leverage, the entire capital position is exposed to the performance of that one asset. If the property performs well, the capital performs well. If the local market underperforms, if the neighborhood declines, if the property has structural issues, if vacancy rates in that specific submarket rise, the entire capital position absorbs that underperformance fully, without the buffer of leverage that would have allowed the same capital to control multiple assets in multiple locations. The same capital that pays cash for one property could, with leverage, control 2 or 3 properties, each one in a different submarket, each one with different tenant profiles, each one producing income and building equity separately. The diversification that leverage enables is a form of risk management that the cash purchase forfeits, not because debt is inherently better, because concentration is inherently riskier than distribution across multiple positions. And the investor who paid cash, believing they were being conservative, has actually concentrated their risk more than the investor who used leverage to spread the same capital across multiple positions. The second cost of the cash purchase is opportunity cost. Capital deployed in a cash purchase is fully committed to that asset. It can't be deployed elsewhere without selling the asset. A leveraged purchase commits only the down payment. The remaining capital stays available to be deployed into other positions, into other assets, into the next opportunity that presents itself. The cash investor is fully deployed in one position. The leveraged investor is deployed in a position with capital remaining to compound elsewhere. Over time, the compound return on the deployed capital and the capital that remained available to deploy can significantly exceed the return on the fully committed cash position. None of this means leverage is always right. A cash purchase makes sense when the position is structured correctly, when the income from the asset doesn't need to service debt, when the investor's overall portfolio is already diversified, when the capital committed isn't the investor's only resource. But calling a cash purchase conservative without examining the concentration risk and the opportunity cost is an incomplete analysis. Conservative relative to financing risk, yes. Conservative overall, not necessarily. The risk doesn't disappear with the mortgage, it shifts, and the shifted risk, concentration, and opportunity cost is just as real as the financing risk it replaced. Understanding both sides is what produces an informed decision rather than a reflexively cautious one. The way leverage scales a real estate portfolio is not intuitive. Most people think about scaling linearly. Save more capital. Buy another property. Save more. Buy another. One property at a time, each one requiring the full capital input before the next can begin. Leverage doesn't work that way. It scales differently. And the compounding that results from that different scaling mechanism is one of the primary reasons real estate has historically been one of the most effective wealth-building vehicles available to non-institutional investors. The basic scaling mechanism works like this. Capital is deployed as a down payment. The leverage controls a larger asset. The asset produces income, builds equity through debt paydown, and appreciates over time. As equity builds through appreciation and debt reduction, that equity can be accessed through refinancing, not a sale, a refinance. The property stays, the income stays. The equity that has built is extracted as capital and deployed into the next position, which produces income, builds equity, appreciates, and eventually gets refinanced to fund the next position. Each asset funding the acquisition of the next without requiring the investor to generate new capital from income or to liquidate existing positions. This is the mechanism most people who have built significant real estate portfolios have used. Not saving for each down payment from earned income, using the equity that existing positions build through appreciation and debt paydown to fund the next acquisition. The portfolio compounds on itself, each position contributing to the next, the leverage amplifying the equity growth that funds the expansion. Without selling anything, without liquidating what's been built, without requiring the investor's earned income to fund each new position. The assets fund each other, over time, through the mechanics of leverage, equity accumulation, and strategic refinancing. This scaling mechanism has specific requirements. The positions have to be underwritten correctly. Cash flow has to be adequate to service the debt and maintain reserves. The refinancing has to be done at the right point in the cycle, not under pressure, not forced by market conditions. And the investor has to understand the mechanics well enough to execute the strategy over a long enough time horizon. 5 years, 10 years. The compounding that leverage produces in real estate is not a short-term phenomenon. It's a long-term structural process that requires patience, correct underwriting, conservative cash flow management, and a clear understanding of how each refinancing decision affects the overall portfolio trajectory. Most people never access this scaling mechanism, not because it's unavailable to them, because the misunderstanding of leverage, the association with dangerous debt, with speculation, with financial overextension, keeps them in a cash-only framework. A framework that is safer in a narrow sense, no financing risk, but slower, more capital-intensive, and less aligned with how real estate actually compounds at scale. Understanding leverage correctly, not as debt to fear, but as a structural mechanism that amplifies returns and enables portfolio growth, is the difference between building a real estate position slowly, one cash purchase at a time, and building one that compounds on itself, each asset funding the next, over a time horizon that eventually produces outcomes cash purchases alone could never reach. If this shifted something for you, subscribe. Like this if it clarified something.